Dr. O, as we were, kind of kicking around ideas for show prep, you said mortgage delinquencies. Like, okay, I got to get dialed in and figure out what's going on with mortgage delinquencies. I don't know that I have the updated, third quarter information in front of me. I might be lagging behind, so you have to kind of pull me forward here. As we close the second quarter of this year, so, basically after June, the total delinquency rate was sitting at 3.93%. Or early stage delinquencies, where people are just 30 days past due, actually had decreased at that point to 2.1%. And late stage delinquencies, and this is where you're really getting in trouble. You're like, you are on the precipice of foreclosure at this point. Had been measured at 1.57%, which was a decrease from Q1 of 2025, but was an increase overall. And the foreclosure inventory rate was at 0.48%. So 99.52% of people holding mortgages were not, I guess, facing foreclosure. What's happened?
Where do you get your data from, Chris?
Well, I just basically made this. I made all of this up. This is somewhat of an AI generated multi-source, information spread that I have. But I am coming to you.
Look, here's what I'm
to fill in the gaps and to bring me where I need to be.
I'll bring us home. I think the reason I wanted to talk about this is everybody's been so concerned about, the price growth slowing down. In some markets, especially in the Sun Belt, prices actually falling, right? You look at Austin, Phoenix, in the housing market. And and essentially the two things, when prices fall, the value of your home decreases, right? And at the same time, the unemployment rate increases. And at the same time, you start to fall behind on your mortgage payment. Well, all of those factors, right? If you don't have a lot of equity in your home, if you are suddenly unemployed, right? All of those factors kind of raise the risk that you will not only fall behind on your payment, but actually go into foreclosure. And so this conversation is starting again, where I'm starting to hear more and more people talking about, hey, delinquency rates and foreclosure in the housing market. And so I wanted to kind of debunk this right here, right now. Not a lot of activity there. In fact, delinquency rates, if you just look at the share of mortgages, outstanding mortgages that are past due, 30 days or more past due, it's slightly below where it was before the pandemic. 2.8% versus 2.9% in 2019.
What's your measurement here? What, as of when?
This is as of Q2 of 2025.
Okay.
And it's data from the National Mortgage Database produced by the FHFA. So it's the aggregates, and it tells us, look, ultimately, it was really low during the pandemic because we were flush with cash and home equity was rising like crazy, and people refinanced their rates and got really, really low rates, in 2021, right? And so their mortgage payments were super low. It was true across the country. And now it's back on the rise, but it's still below where it was before the pandemic, right? You might argue, okay, it's right there where it was before the pandemic. 2.8, 2.9%. It's about the same thing. Okay. So that's the story. The story is, right, we went to a period where mortgage payments were very low. The labor market was on fire. Savings were high. Excess savings were abundant. Everybody was flush with cash. And now we're going back to normal, and normal is basically a 2.9%, delinquency rate. And that's so that's the story here, is that there's no, there's no reason to sound the alarm yet, to jump out of our seats and worry about, homeowners, falling behind on their mortgage payments, and that being a source of, another source of trouble for the U.S. economy. We're not there yet. Now, maybe an interesting story is the fact that, look, it's kind of high. It's higher, I would say relatively higher in the South, in those Sunbelt markets, right? That where homeowners that are trying to sell their homes, well, some of them are accumulating on the market and sitting on the market for longer, right? We have a lot more housing inventory in Austin, for example, than we had before the pandemic. And so sellers are facing some serious competition to try to unload their inventory if they're really desperate to sell.
But that's that is like, I mean, you can correct me here, which I'm sure you will, almost like an opposite equal reaction, because that was, the markets that were the hottest are now somewhat the coolest because everything was pumped up, the demand in particular for places like Austin, Phoenix, Nashville, and then, certainly in Florida. I mean, there was a tremendous amount of interest, 5 years ago and up to
maybe the interest is still there, right? I mean, I'm one of those people that I'm not quite sure that I buy the argument that that the flows of Americans to Florida and Texas are going to stop. I really don't buy that argument yet. I know that things got unaffordable and things are becoming affordable again, right? And I also know that, when you're faced with a demand shock, right? Big increase in demand, supply usually reacts in the same way. You increase demand for housing and there's a lot of money on the table, right? Prices go up a lot. And so builders kick into gear. They go out and build houses because they don't want to leave that money on the table. So, supply tends to follow demand. And that's what happened. Those markets built like crazy, during the pandemic. And now you have a lot more housing inventory, in those markets. And that's kind of the story here. It's, of course, with more, by the way, mortgage rates more than doubled in 2022. So, when mortgage rates ease a little bit and things get back to normal, I suspect you're going to start to see demand absorb a lot of that inventory. And price growth will get back to kind of a normal, state of affairs. Now there is one concern.
Tell me about it.
That I have is its insurance costs. Insurance costs are changing the affordability map across the country, but
we haven't talked about this, but I'll tell you, I mean, the losses that have been sustained by carriers big and small, frankly, are manifesting themselves, in ways that are, in some cases, depending on where you live, shocking increases in homeowners policies.
Yes. Yeah. Especially in Florida. I mean, if you have a second home, right? And, in that market, and you're faced with this increase, especially if you're on a fixed income, if you're an older individual, retired, and you have a second home in that market, well, or a condo, a lot of these people are thinking, hey, maybe it's time to get rid of the condo. Now, unfortunately, there's a lot of inventory on the market.
Well, that might be driving some of the supply that exists. I mean, I think there were a lot of people who bought escape houses in states where the COVID policies were not nearly as stringent. And now, it's like, are we still using this property? Is this, I think there's been maybe a mindset change with regard to to some of these second properties among people who own more than one. And
ultimately, if you're in the market, if you're selling in those markets, you have to realize that, higher insurance costs are going to show up in lower home values, right? And so you have to be prepared for that. Going into the market, you got to price strategically. You got to say, you got to say to yourself, look, this house is not worth what it used to be because of, higher insurance costs. Also, look, it's not going to be the same everywhere, right? So I just want to share that. It's like, there are pockets where it's going to be tough, but ultimately, look, lower prices bring out buyers, right? When valuations get right, you start to think again about, hey, maybe that might be a good time to, take some of that real estate. If I can afford it, it might be a good time, right? And that's how you make money in anything. It's how you make money in the stock market. It's how you make money in real estate. You buy when it's low, right? And you buy when everybody's running for the hills. You buy when everybody's selling, right? There might be some upside, right? As soon as we get past this moment of uncertainty, right? Past, around the economy, and even around the trajectory of mortgage rates and all that stuff. I think it might, you might start to look at some of these opportunities out there. A city like Austin's not going away. No matter what you hear from the
doomsayers.
The doomsayers. That's
yeah. Yeah. The doomsayers have had a field day with regard to the impending crash. And I think you and I have talked about this. Oh, so I'm for sure several times.
Look, yes, Phoenix is in the middle of the desert. It's really hot out there.
Yeah.
All right. I can't say anything about Phoenix, but look, ultimately, I think Austin, Texas, a lot of cities in Houston, Texas. These cities are not going anywhere.
Yeah.
Let's just be honest. Let's be real,
Well, I appreciate your thoughts as always, and we'll call it good there. Just one last shot as an update. I checked in with Freddie Mac, 30-year, fixed rate, 6.17%, 15-year at 5.41%. So,
it's gone up a little bit. Freddie Mac's a little bit behind, but it's a little bit behind, about a week behind. It's gone up a little bit. It's in the 630s now. Right, 6.3, but that's because of the Fed. The Fed came back. We look. Traders expected another rate cut after this one, right? And now that you have the dissent and you have the Fed chair saying, "Hey, this is far from guaranteed," there's been a repricing that has caused the 10-year yield to increase from below 4 to above 4, and of course, mortgage rates also increased as a result. So that repricing took place after the Fed meeting, and now the probability of a rate cut in December actually fell from almost 97% a week ago to just 60% today.
Yeah. Well, let's call it good there. I appreciate the conversation. For Orphe Divounguy, this has been Chris Krug. Subscribe to Everyday Economics wherever you get your podcasts, and make sure that you listen to Dr. O and me each week on the Center Square Radio Hour.